Dear friends, now we are moving on to 1.5, the topic elasticity of demand. What is elasticity? The name or the word is very common to you. It is the contraction or the expansion tendency which is called as elasticity. Here again, compared with the demand or in context with the demand, what is elasticity of demand? Elasticity of demand is the quantity demanded or the moment in which the changes in prices and the changes in the quantity demanded moves from one point to other. This is looked from the viewpoint of the business firm. So it is very important to know to what extent the relationship or the degree of response of a demand of a product changes in relation with its determinants. The differences in responsiveness of demanded can be forced by comparing or can be found by comparing the percentage of changes in prices and quantity demanded. This is called the concept of elasticity. Now you have been given different situation in page number 2.22. That is a fall in the price of a headphone from 500 to 400. The quantity demanded increases from 100 headphones to 150 headphones. In the second case, the price of wheat falls from 20 per kilogram to rupees 18 per kilogram, whereas the demanded quantity increases from 500 to 520 kilograms. In the third case, you see that the fall in the price of a salt from 9 per kilogram to 7 rupees 50 paise per kilogram, the quantity demanded increases from 1000 to 1105 kilograms. Now, what do we understand from these three examples? There is an increase in the demand of headphones. There is an increase in the demand for wheat and also salt. But the degree of differences is different from one to another. The amount of headphones increase for rupees 100 in the change in the price and the amount of kilogram of wheat increase for 1 kilogram price to the decrease of 2 rupees per kilogram in the cost of wheat and rupees 1.50 for salt is different. The ratio of increase in the product is not the same in all three cases. But you can find that there is a percentage of increase in all these three examples given by. Here we are able to understand the concept of elasticity. That is, when the commodity purchased is a function of many variables such as price of the commodity, price of the other related commodities, income of the consumers, and other factors on which the demand changes, a change in one of these independent variable will cause a change in the dependent variable. That is, the amount purchased per unit of time differs for each change in the variable. So the elasticity of demand measures the responsiveness of the quantity purchased per unit of time to the change in any one of these independent variables. Like say for example, price, taste and preferences of the consumer, income of the consumer, price of the substitute products, all are independent variables. They aren't dependent on each other. But all these variables, they change the demand of the product. So demand is a dependent variable on these. Now what percentage of change does these independent variable brings a change in the demand of the product. When these two are connected together, we learn or we talk about the elasticity. So we can clearly explain that elasticity of demand is defined as the degree of responsiveness of the quantity demanded of a good to changes in one of the variable on which demand depends. Demand depends on different variables. For every one variable, what is the responsiveness towards the demand for that product when it is compared? We understand the elasticity of demand. And to be very clear still, the percentage of change in the quantity demanded divided by the percentage of change in any of the factor is called as elasticity of demand. Now this elasticity, when I say, we talk about in relative with price, cross elasticity, income elasticity, advertisement elasticity, and substitute elasticity. But generally, whenever elasticity of demand is spoken about, it represents price elasticity alone.